we are still expecting some more people to come in. But on behalf of Star Village, I would like to welcome Mr. Venkateshan, Director for BSR and company representing KPMG. Also, Mr. Srijit, Savit, and Keith as well. So they'll be running through a small workshop or a small discussion on what exactly needs to be done in terms of the taxation part and the finance part of the enterprise entrepreneur venture that you're undertaking as well. So it's going to be a 1 hour session, and post which we'll have a question and answer round where you'll be able to clarify each and every doubts and queries that you will have. So I'll leave the podium open to Mr. Venkateshan.
Thank you, Judge. Good morning, ladies and gentlemen. All young and energetic people to see in the morning, and also as a facility, incubation facility, we're all getting incubated here, creating from scratch, seeing how it grows, making it big. I mean, it's a good feeling to be around the people here and then see how things are starting from scratch. Yes, one thing that needs to be kept in mind is what's happening is when people start out, the most important thing that runs in their mind is what is that we're going to start, how the business is going to be set up, what kind of products I'm going to develop, how I'm going to sell it, how I'm going to make money out of it. And in that race to find out how I'm going to establish my business, what happens many a time is we never go by to how we have to commercially engage our activities, how we have to set up our companies, how we have to communicate with our investors, how we have to communicate with funding issues, how we have to put in place the regulatory regime, what incentives are available currently in the government system, how to take benefit of it, what conditions are there. If you are looking at any overseas investor, how you should prepare yourself. So all this is generally, when people go for a startup, they give it a backseat. And what happens, what I've seen in my experience over the last 2 decades, is people, whenever these startups come up, people set up. They are very good at it because they are from engineering background and they know how to run their business and how to generate business, how to sell to the customers. But after they grow to a particular size, they fall back and sit and see, have I done the right thing when I set it up? I'm losing so much cash in view of not properly optimizing myself initially, not properly signing up contracts with the customer initially, not putting proper scope limitations in my contracts. Is my products protected? Have I registered my innovations with the patent authorities in India so that it is not being infringed? How much have I done it? Because I would have made more money if I was spending a little bit of time in these aspects. So what I'm going to do today is very generally, briefly, take you through the business setup schemes in India, how if you are getting investors from abroad, an angel investor or an NRI sitting outside wants to put in some initial money into you, how it should come into India, how we should take it inside. What are the incentives that are generally available for your kind of operations, restricted to your kind of operations, so that it's very clear. What are the tax nuances that is there today from a day-to-day compliance perspective? Because today the tax authorities in India at least are not, I can say in this podium, it's not so friendly as in other countries. They always look at you, not even tax, any authority, they always look at you as you have done a mistake and I'm going to find it out. It's not that you are failed to comply or you are missed to comply or you're not aware of it, but now you want to comply, you're ready to comply. They're not looking at it. You are failed to comply, so I'm going to catch you by the neck. But whereas in other countries it's the reverse. So where they're more friendly and then it's more responsible, things like that. So given this background of where we are currently in India, I think tax needs to be given its due importance, because at the end of the day, it eats into your bottom line. It eats into your profits directly. If you're earning 20% and if the tax is going to be 30%, it's approximately 6% of your profit. 6% is eaten away if you don't plan it properly. And 6% doesn't stop there. It has got interest, it has got penalty equal to 3 times the 6%. So virtually, if you get into a tax issue with the authority, and if your business normally earns 20%, and if you don't comply with tax properly, the entire margin is eaten away in the form of taxes, interest, and penalty that is being paid to the government. So that is why in India at least tax is being looked at very, very closely, because that is a straight bottom line growth that you can look at if it's managed appropriately. So what I do is I'll just take you through, and if you have any queries, just stop me there and I'll be able to explain to you further. Or if you feel that you can take their questions at the end of the session also, I'm fine with that. I can go to the session, maybe you can note down it, and then you can go to the end of the session also. Yeah, so basically, as you all must be aware, the Startup Village is a tri-party facility wherein it's approved by Department of Science and Industrial Research, and it's also a co-partner with Technopark and the Morgan, which is the entity which is promoting this and maintaining this facility. And it's the first country's telecom innovator, which you must all be aware of. I'm not telling you something new here. And there's a big vision around this, and hopefully there's slowly reaching that vision of 1,000 startups, which should come in the near future. Okay, what I'm going to do is, as I was telling, take you through the various forms of entity structure through which you can run your organization. What kind of entity you should form when you are embarking into a business venture after you have incubated your thought process or your ideas, that it has become commercially viable. How you should embark into the entity form in which generally the world recognizes you. They don't recognize you by your usual ABC, they recognize you as an entity. Infosys, Wipro, or Microsoft. So you should have an entity which the commercial world can communicate. So which entity is good for you? From that perspective, we will take you through that. The other one we want to take you through is the foreign investment. In case anybody is looking at funds coming in from abroad, either as a debt or as an equity, when you are embarking into the business venture, what are the regulations in India? How it governs it? Is that what you should take care of it there? What you will miss? So all that we will try and address it there. And there are other regulatory compliances. In India, we have got almost, I understand the latest I get to remember is close to 700 plus laws, out of which a company in a year needs to file various types of returns to the regulatory authorities. If you are a full-fledged company, it can be as close as 50 plus returns, various laws. So we are trying to address some of the laws which has to be, you need to address immediately when you embark into a commercial venture. What you need to look at, when you should address them. So we are addressing some of them here. And we are giving a general overview of what is the direct tax, your income tax that a company needs to pay, or an individual when you hire, the withholding tax requirements when you are hiring vendors for your business, what kind of regime is there. And from an indirect tax perspective, what is that you should look at, what are the ways. These are some of the overview we are trying to give you here. From an entity structure, we can have 3 types of entities in India. A company, which is registered with the Register of Companies, limited by issuing shares, which means you will put in the initial capital, wherein the company will allot shares to you. So you are a shareholder of a company. The company is an independent body corporate. Just one thing back on the information. And the other type is a partnership structure. And recently, a year back, or 1 or 2 years back, the government brought in a new regime, limited liability partnerships, which is there prevalent in the developed countries, which is a quasi-partnership and a company, wherein the liability is limited to the partners. In a regular partnership, the liability can go to your personal assets. In case you enter into contract with the business, the vendor, and there is a liability. Normally, all contracts have liability clause. By buying your service, if I get into any loss, you need to make good the loss. That loss can be 100 times of your contract value also, which your entity may not be able to support. If it's a very similar regular partnership, the liability can go to your personal assets also. So they can attach your family properties or your own personal assets and all that. So that is not there in an LLP structure. It's like something connected to the private limited. Now, see, private limited and public limited companies are foreign companies. When you say limited, your liability is limited there to the extent the company has net worth. So beyond that, nothing is there. Whatever you put in money there, you put in 10 lakh rupees into the company, and you have signed a contract of 2 lakh rupees with the vendor, with the customer, and there is a liability that is coming because of the contract. Maximum they can take from you is 10 lakhs. Beyond that, they can't take from you. But unlike in a partnership, even if you put 10 lakhs and you sign a contract, and then there's a liability coming in, what happens if the partnership is not able to meet it? It can go back to the partner's personal assets, which is capped in the form of an LLP. So the LLP gives you the flexibility of a partnership and the limitation of the company. So it is a in between a company and a partnership. So it's more flexible for startups or small ventures type of it, rather than getting to a company which is more cumbersome and compliance and things like that. So a LLP can be a structure.
But the rules are not very clear on the LLP.
No, LLP the rules have come, but only thing is the rules are
somewhere it lacks clarity or something. No.
The clarity in the sense, the rules are new, let me tell you that. And if a foreign investor has to be a partner in LLP, you have to go for a specific approval. And the RBI is yet to notify how the repatriation proceeds have to be there when it goes abroad. See, it's still in the I agree with this, nascent stage, but all the conditions, it's primarily governed by the Companies Act itself and the Partnership Act also. Together, the LLP is governed.
It's actually a reform.
It's reforming, but it's a good form of entity to be in. If you are able to be in with that, it's a good form. I'll tell you the benefits of it as we go along. And the other one is the traditional one. As an individual, I'm a sole proprietor. So here, everything is to your personal account. Only whatever you do, hits you individually, hits you personally, all your things are there. So yeah, as I said, the company is governed by the Companies Act. You need to register the company in the Register of Companies. And the Company Law Board governs the Register of Companies and the formation of companies. And Ministry of Company Affairs is the one which controls the Company Law Board and the Register of Companies. And it can be a private company or a public company. Private company in the sense, next slide is there. Private company, it's 2 people is enough with a minimum of about 1 lakh as your initial capital. That's compulsory. Minimum 1 lakh has to be there. And the minimum directors requirement is 2 people. Those 2 people who are shareholders can be directors also. And in a public company is where the public takes shares in your company, which has to be a larger company in the sense you have to have a minimum 5 lakhs capital. You can have 3 minimum directors. The maximum shareholders is unlimited. So as you grow, as you start, if you want to start as a corporate, it's better to register as a company. Where one benefit of the company is each person can allocate shares, and the shares are transferable free. You can just transfer the shares, company gets transferred. So that is one benefit out here, and the liability is also limited. And when you start, if you want a corporate setup, it's better to start as a private company where the capital is thin, and the requirements are also very less cumbersome, and you can do that. Public company, you have to go after you are embarked into a larger scale. I would say if you're really growing and then you have vision to go public, that's when you should register you as a public company and then get into public. Yeah, when you incorporate a company, first you should look at the name. You have to apply to the ROC for name approval. What name you want to keep for the company. So once you apply the name approval, ROC will check its website because blocking the name is very important. And I would suggest if you are starting anything now, you can apply to now itself to the ROC to block your name, because if somebody else, what happens in many cases is, I've seen many people where foreign companies, like for example, KFC or something also, somebody would have registered here KFC India Private Limited. So when that guy wants to come and set up shop here, the ROC will not give permission, saying that already a name is registering that name, I will not give you permission. So what will happen? Compulsorily KFC has to buy this guy with a premium, huge premium, because it's a brand image for it which has developed all over the world. So when you are setting up, I would suggest at least block the name. Make an application to block the name so that even if you don't use it, others don't use it. So that is one important thing that you should do. If you have thought about what is the uniqueness in your incubation, you would have thought about a name for it. Block the name for now itself. So that is one thing which you should do. And once your name is done, and the next process is you file the memorandum and articles of association to the ROC. Memorandum and articles is nothing but what is that your company going to do? In what business you are going to enter into? IT business, whether you are going to be trading in it, developing, rendering services. What are the types of activities you are thinking of doing? You should have a main object clause and a sub-object clause. Main object clause should be a core business. Sub-object clause should be other businesses. Like for example, you might have taken a space and you might be using only half of the space. Remaining half you may want to sublet it. Your memorandum should provide in the sub-objects, that as a company I will also undertake the activity of letting properties. Then only you can do that. So whatever activities you propose you will be doing, all that has to come. As a main object is one set of activities and sub-activities as a subset of activities. And after you have filed the memorandum and articles to the ROC will examine your application and see whether all the terms are appropriate in terms of the company law. And they will register the company and give a certificate of incorporation. That is when your company is set to be set up and commenced operations. So after that, you can, for a public company, you may have to obtain a council approval. Maybe that is not applicable for you at this stage. So once the company gives a certificate of incorporation, you are ready to commence business.
Do we need to have a physical office for getting this approval?
Yeah, see, you should have the register office. When you are registering the company, you should give an address. So you should have at least a register office address. And register office can be in this one room, we can have 100 companies also. They are not bothered about, we should have a space, size and everything. We need an address where if they send a letter, you will receive it.
But if you want to go for this service tax, they will have to apply.
That is a different thing. See, one is the register office, the service tax, VAT and all that. It requires a space requirement also. So that can be different address. That need not be the register office address. So many people, if you see, all the big companies also, they would have started off in a very small place. Maybe it was lucky for them and they started there. They grew very large. But always you would have seen that register office address would be that only. And they would have grown into multiple places, multiple locations. So all the service tax, income tax, VAT, all that will have those addresses. And register office can be in a place. But one thing is, where you are having a register office, that is where your income tax return will be filed. So you will be assessed to the location where your register office is generally there. But there is a small option to it. You can opt not to file the return in the place where the register office is there, provided your full activity is not happening in that city. Suppose you have a register office one room here, and all your activities happening in Bombay only. Your business is not there, your CFO is there, your corporate office is there, your customers are there, everybody is sitting there. No, here nobody sits. Then you can choose to file returns in Bombay. But typically, it goes with the register office, generally, and they don't normally dispute it. So that is one thing which you should remember. And a register office need not be a physical space that you have to hire a whole building and then keep it for you. You can share your address with the IT staff. You can share your address. Same address can have multiple register office. There is no issue on that. Yeah, moving on to the limited liability partnership. As I was saying, it is governed by the Limited Liability Partnership Act 2008. Though it is 2008, it was enforced only in 2010 or 11. So, as I was saying, the partner's liability is limited compared to a partnership. So, your liability doesn't go beyond the firm. And okay, there is the tax is applicable on that. They have formed a different form of tax. Instead of minimum alternate tax, which is there for everybody, there is an alternate minimum tax. So that is a consequence of it. And it has got a benefit of perpetual succession, like in the case of a company. Company is always considered to be as a going concern. It has got a life enduring Even human beings have got a life to end, but a company is considered to be having a life ever, unless the auditors come back and say that the company's going concern is a concern. The going concern concept of the company is at stake. If a company is having huge negative net worth, cash crunch, no cash available, assets are negative, then the auditors will qualify the company is dying, and then will be referred to a BIFR, Board for Reconstruction. I mean, where there will be a board to see whether the government needs to take over the company and then run it, or it will appoint a committee of government people who will come and sit in the company and run it. If your company is so material and it has got an impact on the society and things like that. So otherwise it's considered to be continuously in existence. Same is the case with LLP also. And there are some tax benefits in this. There is no dividend distribution tax. See, the company, what happens? You have a profit, you pay tax on the profit, you have a profit after tax. And that profit, if you have to distribute to the shareholders, there is a dividend distribution tax. When you distribute, it's called as dividend. So when you receive dividend, the company is supposed to pay a dividend distribution tax to the extent of about 17% today. So you have a profit of 100, you pay a tax of 30%, you have an after-tax profit of 70, you can't take the entire 70 as your cash. You have to pay a dividend distribution tax of 17% on the 70. So you can effectively take back only some 56 rupees. So if you make a profit of 100, you can take back only 56 in a company setup. In a LLP setup, that 17 is not there. If you make a profit of 100, you pay 30 to the government, remaining 70 fully you can take. The partners can share in their share of profit ratio, which they have agreed when they form the partnership. And it's not taxable in the hands of the partners also. That is one big benefit why we are going for this LLP. It has all the characteristics of a company, and it also saves you some money in the form of taxes. So, and also it's easy to set up, and two people can come and then they can join the partnership. But one lacuna when you compare a company is, in a company, two people join the company, each of them have say 5,000 shares each. Tomorrow you may decide to sell 100 shares out of it to somebody. But that you can't do it here. Here, when you are adding a third person as a partner, and if you decide to give a portion of your share to him, both of your partners have to agree that, okay, we are getting this guy, I'll give out of my share, but a consensus needs to be there. So that will lead to various other complications depending upon how you are composed. But in a corporate setup, that is not that. Each one is free to transfer their shares unless a promoter agreement is signed. So when you form a company, two people, when they form a company, they can sign an agreement that today we are forming the company and we will do this activity. And in case any one of us is transferring the shares in the company, I should be given the first right of refusal. There can be some agreements like that. And if such agreements are not there, each one is free to transfer any fraction of his portion of shares to anybody. But that flexibility may not be here fully. So it can happen, but it's not so flexible. Okay, the formation of the LLP, so you have to decide who your partners are going to be. So all you guys will join together. And there's a process of obtaining a DPIN, which is from the ROC. And then again here you have to check the name availability. So what I suggest is with the ROC, whatever name you thought in your mind, go and register. At least block the name. Then you can register the company later whenever you are getting into venture or whenever you are trying to make businesses generate. At the time you can go and register the company also. And you have to put in place a LLP agreement, a partnership agreement typically. And same like a company, you have to file these documents with the ROC. ROC will issue a certificate of incorporation, like in a company. So all the activities are more or less like a company, but it has got a small tinge of partnership. And for a partnership which is not a LLP, it has got Partnership Act 1932, which is the age-old act, where the liability is unlimited, and you have to register this with the Register of Firms, not with the Register of Companies. And the firm is unlimited. Partners are jointly and severally liable for the liabilities of the firm. So they are jointly and severally liable, either individually or together. They have to meet the liability, even though they are personal assets are disproportionate. For example, partner A may have put in 50,000, partner B put in 50,000, but partner J's personal liability may be 50 crores, partner B's personal liability may be only 1 crore. But if the liability is 25 crores, partner A can't say that I'll give only 50% of it, you go and say fine, balance 50%. Since he has got 50 crores of net worth, he has to give for his personal assets the entire 25 crores and he will only give only 1 crore. So it is jointly and severally. Unlike in LLP where it is limited to the partnership's net worth. Yeah. And sole proprietorship, as you must be generally aware, where it is owned by an individual, he is controlling it, he is taking all the risk. Easiest way, you don't have to register anywhere. Initially, you can put up a board name board and then say that this is Kishore and Company or Kishore and Company sole proprietors, so you can run your show. But generally, this is not accepted in a corporate world where you are all dealing with telecom IT software. So when you generate some app and you're going to talk to Apple and you say, I am Ramesh and Co sitting here and doing it. In their scheme of things, they will not understand it very better. So they are looking at a website, a corporate kind of setup, how the legal system is going, because these are unregistered setup. Even if they put a case, it cannot be so strongly viewed. Even in partnership, unless a partnership is registered, not LLP, regular partnership, unless it is registered, even among the partners, if you fight, you can't go for a case. So you have to register the partnership. The partnership can be registered partnership and unregistered partnership. So if it's unregistered, it's even more vulnerable, wherein it's very fluid. Similarly, I would suggest don't go in for a sole proprietorship. If you are in a group and then you are as a group of people you are generating something, go for a LLP or a corporate setup, which will be more stable as you go along. Comparison, this is a comparison chart of what we spoke so far. So under the partnership, it's the Partnership Act, Companies Act, it is the Companies Act 1946 and LLP Act 2008. Registration is optional in partnership. With the company, you have to do with ROC, and here with the register of LLP is running the ROC today. Name of the entity is your choice. Here you have to go to the ROC in the company's case and then block your name. It can be with limited, private limited, or without the name private also. Here again you have to go on. In LLP also you have to go and block your name. Perpetual succession. Partnership, it doesn't have a perpetual succession. In other two, it's assumed to be, it is there for life, never ending. And number of members, here it can be 2 and maximum 20 here in the partnership. In a company, in a private limited company, it is minimum 2 and maximum 50 and unlimited for a public company. And in an LLP, minimum 2 and maximum is unlimited. You can keep joining how much ever partners you want without any limit. Okay. And from a separate entity perspective, not a legal entity separate from partners, it's considered to be a kind of a sole proprietorship, a regular partnership. And company is separate legal entity, LLP is separate legal entity. Board or shareholders meeting, it is not required here, and in the case of the company, it is required. LLP, there is no provision for it. So there is also a relaxation there. You don't have much cumbersome compliance to be done. And obtaining a director's identification number is the deal which I was telling earlier. Partners are not required to obtain. They in both the cases they were supposed to obtain deal. This is primarily to file returns online. The ROC has got various norms to be filed periodically. Every year some accounts have to be filed. In the case of company, any change in shareholding, any change in directors, all that needs to keep filing to them to keep them abreast. They made it online, so they want you to take a deal through which it is recognized. Which will recognize the directors immediately. So through that you can do it. So it's a registration process. Annual filings, no returns are here for the purpose of registrar of firms. And here with ROC and registrar of LLP, you need to file your annual returns, annual accounts. All that is required to be filed there periodically. Yeah. Okay, so far we saw how you will set up your entity structure. Either it should be a company or a LLP or a partnership or a sole proprietor, which is more beneficial generally. So what I'll take you through is now. Yeah. So what I'll take you through now is if you are planning to get any foreign investment into your entity that you have formed, what are the regulations out there? What you should look at it for that? The foreign investment is typically controlled by these 4 regulations. Foreign Investment Promotion Board, which typically controls in which all sectors investment can be made, because it primarily protects